Swayam Prabha. Digital India. Educated India.
So, in the last class we talked about the investment philosophy and the concepts which are related to investment in the market. So, today we will discuss about that various markets where generally the investments are made, and as well as we should also know about certain alternatives which are available in this different market. So, here in this context today we will discuss about the types of investment alternatives and the markets for investment. So, therefore, before going to discuss exactly about the different types of investment, we should know that what exactly these investment alternatives are and how these investment alternatives are defined, and what are those different scenarios in which if the investor wants to invest, then it will be feasible for him to find out the various alternatives which can fulfill his objectives, and as well as the returns can be maximized. So, here if you see this chart, it talks about basically the investment alternatives, there are different types of the investment alternatives, and as well as how this investment alternatives can be categorized. So, here if you see that the investment can be made on financial assets, and also it can be made on real assets. And again the financial assets can be categorized into marketable instruments, non-marketable instruments, and those investment what we make on financial assets, those investments can be made directly and as well as indirectly. Here in the whole course on security analysis and portfolio management, where basically we are trying to learn different concepts, different investment philosophy, and we should now or we should know that different ways how to maximize the returns. So, here basically we will deal with more on financial assets than the real assets. So, most of the instruments or most of the assets what we deal with security analysis and portfolio management, those are basically the financial assets. So, the financial assets can be marketable, it can be non-marketable, we can make the investment in direct way as well as in the indirect way. So, if you see that what exactly this marketable instruments are and what exactly this non-marketable instruments are, really is there any difference between marketable instruments and non-marketable instruments or not. So, those questions we should know before participating in the market. So, if you see that how this particular marketable and non-marketable assets are, the marketable assets are basically we get from the various markets what or which can be managed by the investor, controlled by the investor, And the one of the basic property of the marketable instruments or marketable assets are, without the knowledge of the particular investor, this particular asset, this or the particular instrument can be traded in the market. So, once we take a position or the investor takes a position in the market, and if the market is very much efficient or inefficient, whatever it may be, and if you want to invest in that particular market, and if you know that the particular investment is marketable in nature, then without the knowledge of that particular investor, sometimes this particular assets can be sold, this particular asset can be bought, or in general we can say those assets can be traded in the market efficiently or regularly, even without the knowledge of the investor. And as we know, once we have the position in the market and we know that that particular asset is a marketable asset, then one thing always the investor should remember, that those assets are basically non-liquid in nature. The liquidity of that particular assets are not that much. It is because once we have the position in the market to invest that particular marketable assets, then in that context it is not possible immediately to encash or to convert those assets into the cash, which is the basic theme or basic concept of liquidity. If you define liquidity, how this liquidity is defined? Liquidity is basically nothing but how fast you can convert one particular asset into cash. But if that particular asset is marketable asset, then it is very difficult to convert that asset into cash very quickly. That is why most of, or we can say all marketable assets are basically non-liquid in nature, or the liquidity of that particular assets are very less. Then coming back to the non-marketable assets, the people, particularly if you go back to the previous discussion what we have in the previous class, in that case what we have seen, there are certain investors who are very much risk averse in nature, or they do not want to take the position in the market in such a way where the uncertainty is involved or where there is a risk is involved. So, in that context, those people also invest in the various ways in the various financial assets, like we say the bank deposits, or we can say the post office deposits, national savings certificates, etc., etc. There are various assets which are available, and those assets, if we see, these are basically we do not have to manage that asset. Once we deposit that particular money in the bank has the obligation, or the financial institutions where we have put the money, they have the obligation to invest that particular money or to manage that particular money. So, here the individual investor does not have to do the management aspect of that particular asset, but the minimal amount of the return can be achieved after a certain period of time from that particular assets which are non-marketable in nature. And anything you want to do with that asset, or we can say you will know what is happening to that particular asset, what you have kept in the various banks or the financial institutions or post office, etc., etc., and what is happening to that particular assets in a particular time period. Without the knowledge of the investor, without the knowledge of the people who have kept that particular money, this particular asset cannot be traded, it cannot be used by the other people, or it cannot be used by the other investor, where the return basically is minimal. But another advantage of this non-marketable assets are basically they are highly liquid. Anytime those assets can be encashed, those assets can be converted into the cash. That is why the liquidity in that particular assets are quite high. So, here if you see one particular observations we can make whenever we compare between marketable and non-marketable assets. So, in the non-marketable assets, the risk is almost nil, or we can say that there is no such kind of risk is involved whenever we invest in those particular assets. But if the particular assets are marketable, then the risk aspect is always involved in that. If the risk is involved, then obviously management of those assets are quite complex, or we can say dynamic in nature. There should be certain strategy, there should be certain philosophy, there would be certain ways through which these particular investments can be made on marketable assets. But if it is a non-marketable asset, then this kind of philosophy, the complexity is not there to manage it. So, therefore, most of the discussions what we are going to do in this security analysis and portfolio management course, basically most of the assets are basically are marketable. So, we deal with marketable assets because the marketable assets have the risk, there is uncertainty involved there. So, once there is uncertainty, there is the market factors which is involved there. So, in that context, if you observe that managing those assets are a little bit complex, or we can say it is more dynamic in nature than managing the asset in terms of non-marketable. So, here another categorization what we have made in this context is direct versus indirect investments. What basically the direct investment is? For example, you are an investor and you want to invest in the market. So, if you are an investor and you want to invest in the market and you have certain money to invest, then what you do? The money is owned by you. In that money you can buy or certain assets in the market, or you can put your money in certain assets in the market to get some return in the future. But the money is owned by you and you own that money. Once you own that money, you put that money directly into the market. Maybe the best example is investment in the stock market. You directly put that money in the stock market in the various stocks, and finally what is happening after a certain period of time, or we can say, if you say that time is the variable which is also the important to get the return from that particular investment, what it happens, once you have put that particular money into that investment, then you get the return out of this after a certain period of time. And already if you know that the return from that particular direct investment, if it is a stock or it is a bond, whatever it may be, the return can be composed of two. One is your dividend, another one is the capital gain. So, the return what you are getting out of that particular investment, that either in terms of capital gain or in terms of the dividend, that is directly goes to you. And the return what you are getting after a stipulated time period, those return totally owned by the investor who invests that particular money in that particular marketable assets. But in other cases, there are some ways through which the investor can put the money in that indirect manner, and the investor does not have to do anything for the investment of that particular asset. He does not have to put his time, he does not have to put his own skill for managing that particular asset. So, simply he has put the money in certain assets, and once he has put that particular money or particular funds in that particular asset, automatically that particular assets can be managed by somebody else, and whatever return will be achieved out of this, the minimal amount of the benefits or the return what you will get out of that, out of this some of the returns or some of the money or some of the benefits will go to this particular agency or particular manager or particular fund manager, or we can say that portfolio manager who manage the fund on behalf of you. So, in that case what we have seen that in the indirect investment, the investor does not have to manage this particular fund directly, somebody else will manage that particular fund, on behalf of you. Once it is managed and the return is realized, out of the return some charge, some kind of fees you have to pay to the fund manager or the person who is managing your particular money or the investment on behalf of you, and finally, whatever remaining return in terms of the capital gain or the dividends will be there, that will goes to the investor who has put the money into this investment. So, if you see, the basic difference between the direct and indirect investments are, in the direct investment the manager or the investor is same, but whenever we are talking about the indirect investment, here you do not have to manage the fund, somebody else will manage the fund on behalf of you with a minimal fee. So, that is why what we can say that whenever we invest it in the market, we should very much clear from the beginning whether we are trying to manage that particular fund directly or indirectly, whether we both of the cases the investor owns the fund, but in one case he owns the fund as well as manage the fund, another case basically he owns the fund, but he does not have to manage that particular fund. So, the biggest example or the best example in the indirect investment is investment in various mutual funds. Mutual fund is a buzzword. I hope all of you must be knowing about the concept of the mutual fund, or you must have heard about the concept of the mutual fund, although in the extensive discussion the mutual fund will be there in the latter section of this particular course. So, here I just take that example that whenever we talk about the indirect investment, basically the indirect investment deals with the investment in the mutual fund. So, then going back to the different classification of the financial markets, where this marketable assets are available, and as well as we can say that the different financial markets are involved, or we can get those alternatives in the different markets. So, if you see this markets where these investment alternatives are available can be categorized into various ways. You take the example of in the first case, whenever we classify the financial market on the basis of the claims. What exactly this claims means? It basically deals with the different characteristics of the instruments, different properties of the instruments which are available into the various assets in the various markets. In that context, if you see broadly, the market can be categorized into two ways, equity market and the debt market. There is another category also there where we can say that derivatives market, but here this concept of the derivatives market is a little bit different from the equity market and debt market. Therefore, we can discuss these things in the different manner. But if you see this concept of equity market, what exactly this equity market is? The equity market is basically nothing but who deals with the different stocks or the different shares. But whenever we deal with the debt market, the characteristics of a different stock or characteristics of the different shares which are traded in the equity market, or the investor takes the position in the equity market to invest in those stocks, are totally different from the characteristics of the instruments which are available in the debt market. So, whenever we talk about the equity market, basically it deals with the shares, this deals with the different types of the shares, and what we will discuss in the latter phase in this discussion. But whenever we talk about the debt market, and again the debt market basically categorized into two, one is your government securities market and another one is the corporate debt market. Whenever we talk about the government securities market, what exactly it happens in that case, and whenever we talk about the corporate debt market, what exactly happens in that market, we will discuss it little bit further. But whenever we talk about the on the basis of the term to maturity, in the previous class I was talking about the requirements of the investor is very much important whenever they take the position in the market for investments. That means, somebody may need the money immediately after certain time, maybe after 2 months, 6 months like this, and somebody may require the money in the long period. So, here in the financial market those options are available for the investor if they need the money or they want to invest in those assets basically which are short term in nature, and immediately that thing will be matured after a short period of time and they can realize their return. That market is basically the short term markets, and those short term markets where the short term instruments are traded, these are basically defined as the money market, or most of the money market instruments are short term in nature. But if the investor wants to invest for a long period of time, or he wants to look for, or he is looking for those assets which are long term in nature, they generally go to the capital market. So, most of the cases the short term instruments are available in the money market, and the long term assets or long term instruments are available in the capital market. But here the another question arises, really the instrument which are available in the money market or capital market, these are the addition to the existing market, or the new market is created there once we take the position in the various markets, or only we deal with the existing shares which are available in the market, or we are dealing with only the existing instrument which are available in the market. In this context also the market can be categorized into two. That is why we call it the market can be categorized on the basis of the seasoning of the claims. So, here if you see that in the context of seasoning of the claims, the market can be categorized into two. One is defined as primary market, another one is defined as the secondary market. Basically, the concept of primary market is nothing but we are adding some of the new assets, or we are adding some of the new issues in the market. That is why the other name of the primary market is new issue market. If you take the example of initial public offerings which happens in the market, and it is a very popular word in the minds of the investor, and in the IPO market or the initial public offerings market is basically a primary market. But whenever we go to the secondary market, what exactly it happens? Whatever instruments of the money has been added into the system through the new issue market or the primary market, that money can be traded in the secondary market. So, in the context of secondary market, what it exactly happens, that only this existing shares or existing instrument which are there in the financial market, that will be only transmitted from one investor to another investor. There is nothing to be added newly into the system in the secondary market. The new issues will be added into the system in the primary market. Once that will be there in the primary market, then once it is in the first time it is introduced in the market, then the second case that will be transmitted from one investor or one person to another person through the secondary market. So, that is why we can say that primary market basically a new market or the new issue market, but the secondary market basically is not a new market. It is only transmitting this different financial assets or the marketable assets from one investor to another investor on the basis of their objectives, their requirements, and as well as their investment philosophy. So, here after clarifying these two things, the market also can be categorized on the basis of the timing of delivery. What do you mean by the timing of delivery? Once we have taken a position in the market, or the investor takes a position in the market, he started investing, he may be buying a stock or buying a bond, he started the investment, and after the investment starts, what it exactly happens? It happens that in some day that particular investment will be over, or the particular bond or particular stock will be matured. Once this particular thing will be matured, how this delivery will be made, how this particular return can be realized, and when he can come to know that how much return he is going to get out of this. So, those things basically depends on, or we can define that particular terms on the basis of the timing of delivery. So, that is why this term is defined as the timing of delivery. On the basis of the timing of delivery, the market can be categorized into two. One is your spot market, another one is the future market. What exactly the spot market and future market is? Whenever you talk about the spot market, immediately once this particular transactions are over, or once the settlement process is over, the money will be transacted, or the settlement can be done in the spot market itself. But whenever you talk about the future market, what it happens, the investor takes a position on so and so date this particular settlement will be made. Today you are deciding that on what date this particular settlement can be made or particular transactions can be made. So, in that context that market is defined as the future market. So, in general popularly it is known as the derivatives market, because the pricing of those assets is derived from the various markets like equity market and the debt market. Then finally, we have also the another type of market, that is called exchange traded market and the over the counter market. What exactly the exchange traded market is? That means you take the example of a stock exchange. If you want to invest in the stock market, what exactly it happens? Basically, you do not have, the investor is not required to go to this particular floor or particular trading place where the trading takes place. He takes a position in his home or sitting in front of his computer, and this particular trading takes place somewhere in the stock exchange, and once the trading is over or the settlement process is over, he gets his money or he gets his return. But the over the counter market, physically the investor has to go to the floor and he has to make the investment, or the bidding process will go on in the floor itself. So, that is why that market is defined as the over the counter market. Over the counter the trading takes place, and in the exchange traded market basically exchange or the stock exchanges basically play the significant role for the investment. Then which are the instruments which are available in the various market? Already we discussed little bit about this. In the stock market, it is stocks or the shares what we get for the investment. In the debt market, it is the long term government securities, debentures. Debentures are nothing but it is basically the long term bonds issued by the corporates, as well as the other corporate bonds also available. Money market, basically it deals with the money market mutual funds. Sometimes we talk about the treasury bills. Treasury bills are also the short term instruments which are traded in the money market or which are available in the money market, and the commercial papers. And whenever we talk about the derivatives market, there is various instruments which are available are the options, these are the futures, these are the swaps, and within options also you have different types of the options, you have call option, you have put option, and as well as also in terms of the future we have the instrument like interest rate future, or we can talk about the exchange rate. There are exchange rate future, etc., etc. There are various type of future markets also available in the context of derived instruments. If the instruments are different, then the investment alternatives in the derivatives market also are different in that context. Then the next question we should discuss, or always is there in the mind of the people, that whenever you talk about the primary market or secondary market, what we discussed now, or already we know that the primary market is basically a new market, or we can say that it is a new issue market, but whenever we talk about the secondary market, it is basically a market where only the transaction takes place between the existing shareholders with the existing shares. There is nothing new to be added in that particular market. So, whenever we talk about the new issue market or the primary market, then which are the instruments available and what are the different ways through which the equity capital is raised in the primary market. Already I have given the example of initial public offerings. So, in the first case it is basically the public issue. What do you mean by this public issue? The public issue is nothing but it is selling the securities for the first time. I hope all of you must be very much acquainted with the initial public offerings concept, where recently also most of the companies are raising their funds or raising their shares in terms of the public issues or the initial public offerings. So, like the Reliance and your like the other recent issue was made by the Reliance, which was not very profitable business for the Reliance or which did not click in the market. So, here what we see that there are various processes through which the public issue made. The various processes are basically the book building process, and here we will not discuss about the what the different steps of the book building process. Further in the various in the further sessions we will discuss about the what exactly the book building process is. But here basically if you see this public issue is nothing but it is selling the securities for the first time in the market. And another type of issue also companies make in the primary market, that is defined as right issue. A right issue is nothing but it is issuing rights to the existing shareholder. That means, whenever they go for the public issue, what they do out of the total shares what they raise from the market through these initial public offerings, out of them certain amount of the assets is raised through the right issue. What exactly this right issue means? The right issue means whatever existing shareholders are there in the company and whoever their existing shareholders are available in the company, what these companies do, they generally give certain priority to the existing shareholder or they provide certain rights to the existing shareholder to own that particular shares. It may not be open to the common public, it is only open to this particular investors which are already existing in that particular company. So, that is why we call it the right issues. Then another issue is the private placement. It is basically what exactly this private placement is. The private placement is that whenever you go for the public issues or the any kind of new addition to the system, then you give the priority, you sell the securities to different financial institutions, mutual fund and etc. in terms of this particular new issues or in terms of their primary issues, what they are raising into the market in that particular time. Here what we can say that the retail investor cannot invest in those kind of assets where the private placements are made. And another way of raising the issue is basically preferential allotment. The preferential allotment is basically it is very much selective only for the listed companies, and only the listed companies can go for the preferential allotment. The companies which are listed in the stock exchanges, they can only go for this preferential allotment. The other companies, the companies which are not listed in the stock exchange, it is very difficult to raise the money through these private placements. And basically if you observe the value of the private placements are in general are more than the value of the initial public offerings, or it is always higher than the value of the initial public offerings. So, this is the notion always we have, but clearly if you want to know what exactly this difference between the private placement and the preferential allotment, then we can see this thing that the private placements is basically refer to sale of equity or equity related instruments of an unlisted company or sale of debentures of a listed or unlisted company. That means, whenever we talk about the private placement, it refers to equity or equity related instruments of an unlisted company. Private placements are related to sale of equity of an unlisted company, but whenever you talk about the debentures, it can be both listed and unlisted. But whenever you talk about the preferential allotment, either it is in terms of equity or we can say equity related instruments, they always issued from a listed company. So, the private placement, if they are raising in terms of equity, it should come from the unlisted company, but if it is a debenture or the bonds, it can be also from a unlisted sale of debentures. If it is talking about the bonds or debenture, it can be listed and as well as unlisted. But whenever we talk about the preferential allotment, it is basically the sale of equity or equity related instruments of unlisted company. So, this is the basic difference between the private placement and the preferential allotment. Then after discussing the various instruments or the different ways through which this primary market has raised the money from the market, or we can get the different instruments in the primary market, then we can discuss about the secondary market. Already what I discussed with you that in the secondary market only the existing securities are traded or existing securities are issued. That means, what we can say that existing securities issued in the primary market are traded in the secondary market. So, this market enables the participants who held securities to adjust their holdings in response to changes in their assessment of risk and returns. Already I told that whenever one investor takes the different position in the market, so taking the different position in the various market is basically depends on his risk return profile or the risk appetite in nature, or we can say that how much risk he can take into the market and how much return he can expect from the market, and accordingly by assuming the risk return trade off, they generally decide or the investor can decide that where to invest, where not to invest. The secondary market operation basically can be made in both the markets, what we have already discussed. It can be operated through over the counter market, or in short we call it the OTC market or the exchange traded market. In both the markets, the secondary market transactions take place. Already little bit we know about this, that exchange traded market are basically the stock exchanges where the securities are traded in that there is no need to go to the floor directly or the physical presence of the investors are not required. But whenever we talk about the OTC markets, these are basically the informal markets where the traders where the trades are negotiated. The traders or the investor goes to the market, generally the bidding process goes on there. There is ask price, there is a bid price, and where this particular bid and ask price match to each other, or they can be reached to a negotiation point. In that point only the trade takes place. So, that is why we call it OTC markets are the informal markets, and most of the government securities are traded in the OTC market or the over the counter market. And all the spot trades basically the all the spot trades where the securities are traded for immediate delivery and payment takes place in this market there itself. But if you talk about the take the example of the government securities in terms of OTC market, what it exactly happens that basically it is auction process which is made by the Reserve Bank of India, and they generally go by the auctioning of the various dated securities and as well as treasury bills, and then the auction process goes on weekly, and accordingly the different financial institutions or the investor goes for auctioning, and the bidding process goes on there, and once this negotiation has been made, this particular trading can be taken place. So, here if you talk about, now we are talking about the operations of secondary market, how the secondary market works. If you observe that secondary market operation basically has two steps. What are these two steps? One is your trading, another one the settlement. Once the trading takes place, after certain time the settlement takes place for the delivery. So, the trading things whenever you talk about, here the trade can be takes place in the open outcry system and as well as in the screen based system. And the settlement in India particularly, we have the three type of mechanism. We have account period settlement system, we have carry forward mechanism we have rolling settlement system, but gradually those all the systems are not operating at a time. Basically, these are the different developments in the settlement process over the period. So, one by one if we discuss, we can come to know what exactly they are. So, whenever we talk about the open outcry system, what basically the open outcry system is? Under this system, traders shout and resort to signals on the trading floor of the exchange, which consists of several trading posts for different securities. Buyers make their bids and sellers make their offers, and bargains are closed at mutually agreed upon prices. That means, in the open outcry system, the physical presence of the investors are required. Once these investors are physically present in that trading floor and they take the position in the market, so basically what they do, the buyers go for bidding that particular different assets, and the sellers basically go for asking this particular price, and once this process goes on, the auction process goes on or the bidding process goes on, and they generally negotiate to each other. Once the negotiation is over and they are agreed upon a particular price, this particular transaction can be takes place. The transactions can be taken place. But here what we can say that this physical presence of the investors are required in the open outcry system, and the investor has to go to the floor and they take the position, and the buying and selling process should go on. But whenever we talk about the screen based system, what it happens in the screen based system? In the screen based system, basically buyers and sellers place their orders on the computer. Already what I told, they can be limit order or the best market price order. There are two types of the orders what we have in the screen based system. The computer constantly tries to match mutually compatible orders on price and time priority. That means, if you want to buy it, you have given some kind of price. If this much price is available, I can go and buy this particular asset, and who wants to sell it, already he has sent his quotation to the stock exchange that I want to sell this particular asset or particular stock if the price is this much. So, what this particular process, the screen based system does, basically the screen based system tries to match or is try to find out the particular people or particular investors where the both buying price and selling price can be matched, and this particular matching may be on the basis of the price and as well as the time. So, if both price and time is perfectly matched, then this particular transaction can be taken place. So, here already what I told that the order can be limit order or the best market price order. The limit order book or the list of unmatched limit orders are displayed on the screen. The limit order in this sense, basically what happens, this investor gives a particular price limit. If price is only up to this much, then I can buy it, or the seller can say if the price is up to this much, then only I can sell. So, that is called the limit order. But whenever we talk about the best market price order, basically it is defined as the investor generally always wants to buy or sell on the basis of the best market price which is available in that particular time. There is no such limit is available for that. It is basically related to the market price or the best market price is availability in that particular stipulated time period. So, that is why in the screen based system there is no need of the physical presence of the investor into the trading floor. And this screen based system trading is started in India in November 4th 1994 in NSE, and afterwards it is quite popular in most of the countries, and in India also it is quite popular. Because why it is popular? It is popular, or it is, we can say that is most used type of system. It is because it increases efficiency. It generally saves the time, there is no need to go to the floor, there is no need to go to bargain with the different investors for a agreeable price, or we can say that for a matching price. So, that is why it increases the efficiency. because we can get all the information from that trading computer based system itself, and once we have the information, what we can do here itself, we can take our positions in the various places to maximize our return. So, that is why what we can say that the screen based system basically increases the efficiency into the market or into the system. It increases the confidence in the market. Why it increases the confidence in the market? Because all the informations are available there itself. So, all the investor can come to know which stock is available at what price or which asset is available at what price. Accordingly, they can choose on the basis of their risk return profile. It is definitely transparent, because the transparency is maintained, because you have to provide all the information in that itself, and the regulator takes care of those things whenever they take the position into the screen based system. It reduces the brokerage cost, it reduces the paperwork, and also it reduces the bad paper risk. There is a probability of losing the paper, there is a probability of destruction of the paper. So, we can avoid those things once the computer based system is working. And here if you see the data, that most of the transaction cost, the huge amount of the transaction costs have gone down like anything over the periods in the context of India, once the screen based system is started into the Indian stock market. Then the another step is the settling. Once the trading takes place, how the settlings are made? The settling basically in the traditional way, how the settling was doing, that it is basically based on the physical delivery. The seller basically, whenever he wants to sell some of the stock, the seller goes to the seller's broker, maybe he has a broker, he goes to the broker, then that seller's broker finds out the buyer's broker, and finally the buyer's broker will look for a buyer. Then only the settling takes place. That means first the process should go from seller to seller's broker to buyer's broker, then buyer's broker to buyer. But in the modern system, how the settling takes place? It is basically takes place in the basis of the electronic delivery. What this electronic delivery is? The electronic delivery basically facilitated by the depositories, and what the depository is defined and how this depository is defined. The depository, which is an institution which dematerializes physical certificates and effect transfer of ownership by electronic book entries. For example, you have bought a stock or you have sold a stock, and once this particular process has happened in that stock exchange, then what has happened, that it is the role of depository which plays the significant role by transferring the ownership from one investor to another investor. So, that is why in the modern electronic delivery system, always the depositories play the significant role for settling of that particular investment or the trading of that particular investment. So, the examples of depositories in India are National Securities Depository Limited, NSDL, and the Central Securities Depository Limited, that is the CSDL. Over the period, how the settlement procedure works in India. Previously, whenever the particular exchange traded system is started, or we can say that whenever we do the trading in the stock exchanges or we do the trading in the equity market, previously this carry forward system or carry forward mechanism was working into the Indian market. So, in the carry forward mechanism, what it happens? When a bull buys, bull means the particular investor who always expects that the price will go up, and the bear means the particular investor who always expects that the price will go down. When a bull buys in the anticipation of an immediate rise in price, but finds at the end of the accounting period that the price has not risen, he may either pay the shares and take delivery, or he has the option that he may carry over his transaction to the next accounting period by paying the carryover charge. That is why this concept is, we call it the Sidha Badla system. Sidha badla to the seller, or we can say that the Sidha badla to the seller. That means he has the option, he may go for the realization of the delivery, or he may also carry over his transaction to the next period by paying the carryover charges to the seller. But if it is just opposite in the case of bears, what happens when a bear sells in anticipation of a fall in prices in the immediate future, but the fall does not happen within the accounting period, he has option to borrow or buy the shares for delivery or have his sales carried over to the next accounting period on payment of unda badla or backwardization charges to the buyer. So, that system was very old system in Indian share market, where the carry forward mechanism was working. But whenever we go for this, gradually it has gone to the account period settlement system. In the account period settlement system, what it exactly happens, that the settlement takes place maybe after 15 days or after 20 days. But previously it was it has come down to a week, but now it is not working. Basically now we have a rolling settlement system. In the rolling settlement system, the settlement generally carried out gradually, and now we are going for T plus 2. If the transaction is at the time of T, your settlement can be made at the period T plus 2 since April 1, 2003. And once this system prevails in the market, it enhances the liquidity of the market, it helps to achieve the true price discovery, it may reduce the price fluctuation, it increases the market efficiency as well as it reduces the market manipulation, because almost all the transaction takes place in a very short period of time. So, whenever we talk about the transactions, the delivery can be made immediately on the spot delivery. Delivery and payment are made on the same day or contract of the contract or in the next day. It can be hand delivery, delivery and payments are made when it is stipulated, the time is fixed from the beginning, or the special delivery, it is beyond 14 days with the permission of the stock exchange. This transaction can be, a delivery can be takes place after 14 days also if the stock exchange wants. Then there is another concept which is related to this, we call it the margin trading. This is the part of the transaction value that customer has equity in the transaction. So, where this margin is used to buy more even if you do not have the money, and as well as by borrowing you can also make the transactions. The concepts which are related to the margin or initial margin, how to define this initial margin? It is basically amount the investor puts up or the value of the transaction, or it is the part of the transactions value the customer must pay to initiate the transaction with the part being borrowed from the broker. From the beginning you have to put this much money if you want to trade with. Then another one is the maintenance margin. The maintenance margin is nothing but the percentage of a securities value that must be on hand as equity. Gradually we can read elaborately about these things in the further sessions. Then margin call, basically it is the demand from the broker for additional cash or securities as a result of the actual margin declining below the maintenance margin. If the price fluctuations are more, if this particular initial margin falls below certain level, then they can go for a margin call. Short selling, what exactly short selling means? In a normal transaction, a security is bought or owned because the investor believes the price is likely to rise. Eventually, the security is sold and the position is closed out. That means, first you buy it, then you sell. But in the short selling, basically it involves selling a security because you believe that the price will decline and buying back the security later to close the position. First you sell, then you buy. So, it is just opposite from the normal investment procedure. So, what exactly this actual selling and buying procedure? First what you have to do, locate a broker, place a order, then what you can do, order may be a limit order or it may be a best market price order. Then once this order will be matched, then the trading will take place, then finally in the T plus 2 settlement process will go on. And the procedure for selling, it is the same, placement of the order, sell order, then you execute the order, and the other procedures are same in the buying process. So, in the mutual fund where it is we do the indirect investment, there are various funds available, close ended and open ended. We have a separate session on mutual fund where we will read extensively, but here if you see the differences between the close ended, open ended are Subscription period is limited for close ended, no right to withdraw the fund when they like, and the close end funds are generally the fixed maturity period and they are listed in the stock market. The open ended funds are not listed in the stock market. So, mutual fund schemes are basically debts, it can be a debt scheme, it can be equity scheme, it can be a balance scheme. So, in the debt scheme basically all are equity. In the debt scheme basically it is 100% debt instruments like the corporate bonds, etcetera, etcetera. And in the balance it is 60% maximum equity or 40% debt, or it debt 60% and 40% is the equity. That way generally it is made in the balanced fund. Why mutual fund? Basically why we invest in the indirect manner? Because if you do not have the expertise for management or to get some tax advantage, because under the various tax rules we have the advantage, tax advantage we have if we invest in the mutual fund. So, the people who basically invest in the mutual fund, if they do not have that much amount to invest directly into the market because of the transaction cost, high transaction cost, if they do not have time to invest in the market, if they do not have expertise to invest in the market directly, and as well as if they have fewer stocks in hand to invest. So, therefore, if certain investor does not have that much time to invest directly, they can go to the mutual fund. In general, what we can say that equity investment, or we can say any other investment in the financial market, always goes to the various process and it can be invested in the various markets, and always the basic objective of the investor to maximize the return with a given constants, and the constants are related to the age, related to time, etcetera, and as well as the risk appetite of the investor. Further, we will discuss about the different concept of efficiency and how this particular market works and when we can maximize the return in the various conditions. Thank you.